So if it doesn't drop at 13, it's going to drop probably at 1450. Devise asks, do I use MACD for divergence? Yeah, sure. They're just measuring different things, right? So the way I use MACD is to measure overbought and oversold conditions for the market, which is just absolutely fine. Okay, so divergence of market, it's just slower, and you're measuring something different. The oscillator I'm using to measure price action. How many people here would like a very quick lesson on MACD? So like a real, not like a trading strategy per se, but actually know what it means. Because I find a lot of, they're like, oh, I got this great MACD trading strategy. Really? Tell me about the math. What does MACD tell you? Oh, I have no idea. Oh, but you have a good strategy, but you have no idea why it works. Good luck with that. Yeah? Sure. Well, let's do one. The reason you don't see MACD on these charts is I just see it. When I trade alone, I don't even use Fibonacci. I mean, I do use it. I don't draw it because I can just see it. MACD and stuff, I just see it. So let me explain it to you. In fact, when I've mentored or done, group training and stuff over the years, one of the things I've done is I've handed out blank charts. I mean, you got the price action, right? But you can't tell what currency pair it is. But you can see the candlesticks, right? And then underneath there's a blank area because I've deleted the MACD, right? And I hand them out to everybody and I say, draw the MACD. Have you guys ever thought about that? Do you think you could do that? If I just gave you candlesticks, right? So you can see all the price action and I say, draw out the MACD oscillator. And they're like, what? Yeah. You have all the information there, right? Draw the MACD. How many people think they could do that? And if you can't, say no. Come on, guys. And it's interesting. Hey, look, you're right. It's interesting because if you can do it, you understand the math going on. And if you understand the math, you understand what it's trying to tell you, and therefore it's not really complicated. Okay? So I should be able to give you this chart right here, right now, and you'd be able to draw the MACD. It's really easy if you know it. All right, so let's do a 5-minute overview of understanding the mathematics of the moving average convergence divergence indicator. Okay. Now, like I said before, I use the MACD to measure overbought and oversold conditions for the marketplace. Okay? Not price action. So I have to separate the two. So you have to start with the basic definitions, right? So when I designed my use of MACD, and you got to remember, I'm self-taught. I've been doing this so long. There was, there wasn't much resources to learn. So I'm self-taught, right? So I looked at the market, and I look at price, and I separate them. And my definition of market is if somebody came up to me, and people used to do this all the time, right? They're like, hey, so how are the markets today? Right? They just want to know, did it go up or did it go down? They're not like, well, for 3 hours it was up, and then 2 hours it retraced, and then it consolidated, then it broke out. Like, that's not what they're asking, right? That would be more price action. They just want to know, hey, is it up or down? And I thought, well, that's actually a very astute question, because I need to discern whether I want to buy or sell. So I used the MACD to do this. And I also used moving averages. Okay, so in this chart, we're looking at an hourly chart. And I need something here to tell me the direction of the market, whether I should be a bull or a bear. So I spent a couple of years experimenting with various moving average combinations. Okay? And I use the 2155 EMAs to represent market. It's the orange line, the blue line. 21 EMA, 55 EMA. And together, they show me the direction for the market. So if the 21 is below the 55, the market is bearish. If 21 is above the 55, it's bullish. Okay, that's pretty easy, right? By the way, it makes me think we should do an advanced training. Like, I should do like a 2-hour or 4-hour event or something like that. do you guys think? I'm thinking that we could just, I could spend the whole time just doing this. Today, I want to set up the trades too, but boy, we could really dive into this, right? Because I love explaining this stuff. It's amazing for so long, and I still love sharing. Yeah. All right. So anyways, the other thing that you can use the 2155 for, and trust me, this does have to do with MACD. If I don't explain this, you'll never understand. Okay. The other thing I'm looking at is the angle and separation. If you have a nice 45-degree angle, okay, then the market is aggressively bearish. And there should be nothing on this planet that would make you consider going long. Nothing. Okay? And the second thing that I look at for, right, is the separation. If they're widely apart, you're very, very aggressive. But if they're narrowing like they are here, the angle and separation is diminishing, the market is slowing down. Now, technically, you see how they're almost touching? I call that a 2155 kiss. The market is still technically bearish, but much, 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 much less bearish than it used to be. Okay? Here, unbelievably aggressively bearish. Then yesterday we broke through this, and I think I was talking about that if the 55 comes down, pushes it down, I would expect a double bottom. If it wasn't this pair, it was a different pair, but it's all the same. Okay? In this case, the 55 didn't even push it down. So technically, we're still bearish, but almost essentially neutral at this point. Okay? Because the distance between the 21 and 55 is almost nil. Okay? So here, technically, the market turns bearish. Market is aggressively bearish. All the way down to here, and down into here becomes a lot less bearish, and then where we are now is neutral. So I thought, you know what we need? We need an indicator to help us see these things, to measure the angle and separation between the 21 and 55 so I can see that information even more clearly. Does that make sense? Because I want to know, is the 20 and 55 moving closer together? And is the 21 above or below the 55? So you know what we need? It occurred to me, a moving average convergence divergence. I want to know if those moving averages are converging, which means getting closer, or diverging, meaning moving farther apart. Now I know when they're moving farther apart, when they're diverging, I should be aggressive. But if they're converging, I should be conservative. Doesn't that make sense? You're like, oh my gosh, well that's why they call it a moving average convergent divergence. That's the name. That's what a MACD does. So let's make a MACD. Insert, indicators, oscillators, moving average oscillator, MACD, there it is. MACD. All right. So what moving averages am I going to measure here to measure the overbought and oversold conditions for the market? What moving averages am I going to input here? Well, I want to measure the 21 and 55, right? The angle and separation between the 21 and 55. So in that case, I'm going in the fast EMA, I'm going to put 21. In the slow EMA, I'm going to put 55. You're like, well, Wayne, why are you changing the default settings? Well, because I'm asking it to tell me the angle and separation between the 21 and 55. I could put whatever moving averages I want here. It's just going to measure the angle and separation between the 21 and 55. That's all. I'm asking it to do the calculations for me. How many periods do I want to look at? I like 8. Why? It's a Fibonacci number. I mean, who cares, right? So that's pretty much it. So let's add this. Boop. Okay. Here's the water line. By the way, I actually use a different MACD. This one is the one that only has one line. Okay, but this is good enough for me for now. Okay, so let me explain this here. Let's move this up even more. All right, so there's the MACD. So you can see that they're drawing one of the lines with a histogram, the other one with an actual dotted line. So there's a few things going on here. Okay? The first one is the water line. When price drops below the water line, the 21 has crossed below the 55. If you see how we get two little bars that pop up for just a little tickle, the 21 was above the 55 and then immediately dropped below the 55. So I can look at this immediately and see here the 21 was above the 55. This is where they were crossing, and now the 21 is below the 55. I see that immediately. That's what this is telling me. So the first way to use the 2155 is to simply answer the question, am I bullish or bearish? Or the actual question, is the market bullish or bearish? Okay, remember? Now the second one is the angle and separation. Are they converging or are they diverging? Okay, when the lines are pointing up and they're moving back toward the water line, they're converging. When they're moving away from the water line, they're diverging. So aggressively bearish, conservatively bearish, aggressively bearish, more and more conservatively, conservative, okay, but still technically bearish. So now if this rolled over and started heading down again, once again, the market would technically be more aggressively bearish. If this continues and it heads above the 21, above the water line, it tells me the 21 is now above the 55, then the market is technically bullish. So do you guys understand the two things it's telling you? Has there been a 2155 crossover? That tells you direction. And the other one measures, okay, whether, I guess the quality, right? So here I'm aggressively bearish, conservatively bearish, aggressively bearish. You can see here, a long time ago, the market was still bearish, but it told you in here to be conservative. Okay, in fact, let's just get rid of this, the Stokes. Okay, Stokes is gone. So right here, you see this? Let me make this a bigger line. Hang on. That's where it crossed over. It started heading back toward the water line. 21 is still below the 55. Okay, but the distance between the 21 and 55 is converging. Okay, so you take this up now, and I'll extend the vertical line from that point. And right there is when the market was already becoming less bearish. Okay, let's do another one. Okay, this is where the market turned bearish again, aggressively bearish, not just technically bearish, but aggressively bearish, right in here as it breaking out and making a lower low. Okay, so on and so forth. When did the 21 cross below the 55? Okay, the first time was here, then it kind of consolidated and then technically there, right? So let's go back to this point. The market turned bearish there. Okay, consolidated, then boom, short. Okay, that's what the MACD is telling me. So whatever the default settings are, just make sure you want to use those moving averages. Okay, breakout, pullback, sell. And you can do this on all time frames, 15 minutes and above. After a while, if you drop into the 5-minute, things like, there's no market in a 5-minute chart, right? So you wouldn't measure it there, but I would use price action like a stochastics. Okay, so now I should honestly be able to give you a chart like this where I change the properties here. I go white, white, Okay. Delete. I deleted the whole thing. Let's just get very quickly. Insert indicators, oscillators, MACD. All right. Wait, boom. I should be able to give you this chart now. I can tell you this is the water line. Okay? And I should be able to say draw the MACD. And you should have no problems doing it. You need to understand what your indicators are telling you, guys. Otherwise, it's just a leap of faith. You know, just reading an ebook you bought on eBay somewhere for $1 and make $1 million trading Forex is just stupid. Okay? You need to understand what the algorithms are telling you. They're tools. Okay? They're not a holy grail. The more that you understand the tools that you use, the more that you can become a master of your domain. Okay? And so two things that I would look at if I were me would be the MACD, which I hope you understand, and also I like to use stochastics. Why do I like to use stochastics? Because it measures overbought and oversold conditions for price action. Because it occurred to me, 10 or 12 years ago, that I need to separate market forces from price action. Because somebody can ask you, hey Wayne, how are the markets today? I could say two things, right? Oh, well, it was up, it was down, it was up, it was down, it was up, it was down. But that's not what they asked me. I could say, well, generally, it was down today. We closed lower than we started. But I know that there were times when prices were actually going up, but generally speaking, it's still a down market. So, wow, there's price and market. There's two different things going on. And if I can align up my price action with the market forces, they would be congruent and aligned.